If you had $100,000 to invest today, would you buy into the S&P 500 or would you put the money down on a rental property? One promises passive growth and the other promises passive income. But the reality is more complicated. Today, I'll break down the math, the mindset, and the long term implications of both paths so you can decide which investment fits you best.
First, we want to talk about what each asset is. S&P 500 is basically, think of it of a basket where you have 500 of the largest US companies. And the awesome part about that is that you're automatically diversified. So it's not like how you usually see with the stock bros, that I like to call them, that will tell you like, oh, go for this stock, go for that stock, and then you're like just buying one stock at a time. Here it is just a basket and there's 500 of these companies, and so you're already like diversified. As far as like the returns that you get on that, it's like on average historically about 10% annually, but when you adjust that for inflation, it comes out more to like 7%. It's easy to buy, it's easy to just like automate like sending money to it. It usually has low fees and it's very liquid, like you could sell it once the market opens. As far as the rental property, it is an asset compared to a stock where it's kind of like a piece of that company. With rental property, it's a physical asset. It's a house, right? And it generates cash flow, which is basically what the income that you bring in for that rental property minus the expenses. What's left over is known as cash flow. For appreciation, you also have the benefit of that, which is basically that asset, that property increases in value over time. The best part about a rental property is that you can leverage that. You could take loans against that asset to do other things like, purchase another property. We talked about it, and did that, and I did a similar thing, but I used the equity for something else. And make sure you check out that video where we talk about a HELOC and a home equity loan, which are some ways that you can leverage against that property to use it for other things. It also has tax advantages. You could depreciate the property and you also have some deductions and you have a little bit more control of that property. Whereas with a stock, that company is run by other people, whereas here you're managing the property. You have more say of what you want to do with it. The thing is that it's not passive. Even with property manager, you have to manage the property manager and you still have to kind of like just track your property, make sure that it's doing well. With stocks, it's passive. You kind of just buy it. And again, the company does their own thing and then you just kind of go with the market. So those are the difference between those two assets.
Most millionaires have these two type of assets, stocks and real estate. And so we can bring you the differences. We are going to compare a little bit of the numbers and of the advantages of these investments. So for example, let's say that you have $100,000 in the S&P 500 and you invest it as a lump sum. And because you've done your research, you know the S&P 500 will give you about 7% annual return after inflation. After 20 years of investing, if you don't put any more pennies into that $100,000 initial investment, it would grow on to be $387,000 after 20 years. In a different scenario, if you were to put that $100,000 as a down payment, for example, in a $400,000 rental investments, which is the average in the country right now, the average house property price is about $400,000. So let's say you put 25% down and then you have a 75% mortgage and you get an interest rate of 6.5%, your monthly expenses for that property, for that mortgage, the leverage mortgage would be around $1,800 a month, $1,800. And your rent, let's say you can't rent this out for $2,500. That means you're getting a cash flow of $700, which it's equivalent to $8,400 per year. And then so we leave this property alone for 20 years as well. You would have after being rented for 20 years, $200,000 of principal paid off, plus most likely $200,000 of appreciation if we assume that 3 to 5% appreciation, which is across the country, plus $168,000 of cash flow, which equals to 568,000 total before taxes. And why is this so important? Real estate return looks stronger on paper if you manage it well and avoid any vacancy of repairs. Also, we're assuming based the net averages. There's many things that you could do during those 20 years, or many things that are going to happen in reality of housing or tenant turnovers or whatever that are going to change, right? Rent sometimes are going to go higher. Your rent sometimes are going to stagnate. But the average is telling you that after all of the principal pay down, after the natural appreciation, after the current cash flow you're getting monthly, you still would most likely conservatively get $568,000 before taxes. Even though S&P 500's 380,000 looks very appealing, and it's purely passive, it has zero operational risk, right? It has less risk than a rental, but the rental has more potential to grow and scale and to become a bigger thing. Also, another thing is that after 20 years, you have a significantly almost paid off property that you can keep on forever. And after 30 years, you can give that to your children. One, you have the $380,000 gain from the S&P 500, you kind of have to spend the money, right? It's just like what it is.
Let's talk about the risk for each one so that way you can decide, which one you want to go for if you are to choose just one. For the S&P 500, some of the risk is that, again, there's some market volatility, and we saw that pretty much this year where, like, you'd mention tariffs, and all of a sudden the market would dip and then it'd come back and everything. So I feel like this year was definitely crazy for the market, but throughout time, it's kind of like a little bit more stable. But you never know what might happen, that might drop the market. And depending when you are eligible to like retire and to be able to actually use that money. When I was working in the military, I know one of the guys there, that he was planning on retire one in like 1 or 2 years. Yeah, he was stressing out because this is his retirement, and then of course we had all that market craziness going on, so it definitely stressed him out. But someone like us, that we have more time, and we're able to recover. So that's one of the good things. It really depends when you are planning to use the money. um, and one of the things as well that caused some of that volatility is because people were panic selling, which can happen when you are investing in the S&P. Is that your emotions, because it's so easy to go ahead and liquidate or sell or buy or whatever, you can do more emotional buying or selling. We saw that with the Dogecoin a few years back, where like people were just buying that stock because through emotion it got popular and trendy or whatever. The same thing with this year is people were just selling because they saw that the market was going downhill, which caused it to go further downhill because people did panic selling. So there's a little bit of drawback and risk with that. And of course, you also have the inflation risk if you haven't been invested long enough. So there's that risk as well. With real estate, there's risk, of course, which Lynn kind of mentioned a little bit. You of course run the risk of your unit being vacant, because maybe you purchased in an area where it just takes a little bit longer to rent out. Maybe there's too many rentals in that area. You also have maintenance issues. Maybe like plumbing is a common one, as far as maintenance, or something breaks or whatever. And of course, bad tenants. Maybe they don't pay on time. You have to evict them, or they just kind of mess up your property. So those are some risks with real estate. Your property is not as liquid as a stock because you have to put it on the market, you have to, show it, you have to get it ready to also put on the market. So it's a whole process to put that into the market and actually get it sold. So it's not that easy. So you can't just like be like with the stock and be like, I'm just gonna sell it tomorrow because it's too much maintenance or whatever, and you want to get rid of it. So there's that risk as well. If you want to like leave, there's some time that you have to account for. And there's also interest rate fluctuations, depending if you have like a variable interest rate or whatever. But also you run that risk. For example, the fix and flips, you are planning to refinance at maybe a certain percentage, and then maybe the market shifts and interest rates really shoot through the roof, and that can hurt your bottom line when you're doing like a fix and flip, or if you're planning to take cash out in a burr or whatever. You also have property taxes that go up, insurance, and also regulations depending on what type of property you have. For example, an Airbnb, you might run the risk of, hey, that city decides that they don't want that many Airbnbs, and now you have to get a permit. And then now you're like, wow, now I have to figure out what I'm going to do with the property, turn it into a long term rental or whatever. So each one has their own risks. It's just figuring out how you can mitigate those risks, which ones are worth it to you, because stocks have the market risk and real estate is more of a management, and of course it not being as liquid. So it's different types of risks that you just have to think about and figure out which one you're okay with.
And then also to talk about the taxes and the leverage part of stocks and real estate. For example, there are tax implications when you're on stocks. Every time you are going to sell, you are liable for capital gain sale. If you have, hold a stock longer than 1 year or 2 years, then you have the long-term capital taxes scale that you have to follow. And then if you have just traded, which means you've been owning the stock for less than 1 year, then there also the gains and the profits are subjected to your income bracket. It's just like a short-term gain, and then it will be taxed as income. But if you hold it for longer than a year, you will incur most likely into the brackets of 0%, 15%, and 20% capital tax gain sale. And you can look that up very easily. It depends what your income falls, as well as if you are buying dividend stocks or types of stocks that you can purchase that also, and on top of giving you, profits years after year, they pay dividends monthly or quarterly. So those dividends are taxed annually. And those are two instances in which you incur taxes. For real estate, in terms of taxes, there's this magnificent thing that the tax code explains is depreciation timeline or schedule. So what does that mean? The depreciation schedule is that the government says when you buy a real estate investment and you're using it for a business like a rental investment, then that means that this investment that you purchase from the beginning, it's going to depreciate because the wear and tear of the investment. A house normal to known that it will have wear and tear after many years of investments. We have a depreciation schedule. We're able to take the value of the house and depreciate it over 27 years, 27 and a half years. So if your house is 100,000 or $100,000, you can depreciate a little value year by year for over 27 and a half years, which is a paper loss. It becomes so powerful at the end of the year when you file your taxes and you start taking that depreciation, and then lowers your income and lowers your taxable cash flow. And so that's why it's so appealing. Then also we have other deductibles like mortgage interest. If you purchase and with a mortgage, your mortgage interest is tax deductible. Another powerful thing about the real estate portfolio is you have the option to do a 1031 exchange. If you don't remember or you don't know, if you own your primary residence and you buy your primary residence, you live in your primary residence and you sell it for profit after 2 years of owning it, then those profits are not taxable up until $250,000 per individual, $500,000 if you're married. And investment properties, you do not have that because you're not living in the property. So if you're not living in the property, whatever profits that you get from selling the property are taxable, becomes a gains tax, a long-term gains tax. But the government says if you take the profits from the investment that you sold and you roll it into another investment, we're going to forget about the taxes. We're going to just defer the tax. And that's what's called a 1031 exchange. When you take the profits of an investment that you sold to buy another investment. And then so you defer the capital gains. Most millionaires do this. You can do this multiple times during the year. You do have to have some rules and regulations that you have to follow, but it's a very powerful thing that from real estate you can use. Another benefit is leveraging magnified returns if the rent exceeds expenses. So, for example, if you're purchasing a house, like we mentioned earlier, for $1,800, it's $1,800 your mortgage that's going to be for the next 30 years, but you're able to rent it out for 2,500, then you have the $700 cash flow, right? But your leverage would stay the same for the 30 years because you get a fixed rate on that mortgage. So most likely your mortgage would not change unless your insurance or taxes change, but your mortgage will stay the same. But you will know the rent flow, it's going to grow over the next 20 years. You most likely are not going to be renting the same thing for the same $700 a month. So that is what is called magnifying your leverage.
It's basically a difference of cash flow versus compound growth. With real estate, again, you have cash flow, which Lynn was talking about. That is monthly income that you are getting now, that is getting put into your bank that you can start using towards financial independence. So if you're someone that is wanting to kind of maybe be work optional or just retire early, cash flow is a great option for that because you're able to use it now. It's monthly. You can rely on it. And the only thing is that it can be harder to scale fast. That's because you usually have to wait. I know Lynn was talking about being able to leverage and more like, borrow against your property. But of course, you have to wait until that house appreciates enough or you pay down enough of the equity to do that. Also, same thing with the cash flow. You can save up like that $700 in this example, and you save that to be able to save up enough for a down payment for another rental property. And that may take some time, but over time, then it gets easier, of course. But at the beginning, it could just be harder to scale. As far as with S&P, the compound growth with stocks, you're sending money, buying stocks, right? And then that stock starts increasing in value, assuming, right, at the 7% annual on average. And that increases that stock and that just gets reinvested in itself, and then it just starts building exponential growth. And it's easier to automate because you can say, hey, I'm going to send like $200 a month each time to buy stocks to invest in that S&P. So now the stock and the dividends from that is increasing, but also you're sending an extra $200. The only thing is that, of course, you aren't able to use that money now. You have to wait until your like retirement age of 59 and a half or whatever to be able to actually use that. So that's more of a long term plan. But really, it's all a mindset game when you're deciding which one you want to do, whether real estate or stocks, because they're two different assets. They're two different things. Real estate is more of a business. I know we talk about like seeing rental properties as assets and things like that, but you're actually running a business. Each rental property, it's its own little small business because you have to think of like the income and all your expenses and taxes and all that. So that's the mindset with real estate. Whereas with S&P 500 is just an investment vehicle. Is you're putting your money in there and then it just does its own thing, and you kind of basically set it and forget it. Like, yeah, you track the market, just to stay on top of it and kind of decide if you're going to sell something or not. But with real estate, because it's a business, it's a little bit more hands on, even if you have a property manager.
You do have to be attuned to your personality. Like, what kind of person are you? Are you somebody that's hands off and likes automation and doesn't want to think about it daily or monthly or yearly? Then you can go ahead and start investing in the S&P 500. If you're somebody who enjoys control, that likes real estate, that maybe you want to put your hands on a rehab and then get into your market and definitely getting to know about your market, then take a look at a real estate. If you have a higher income and you want to shelter some of those taxes that you are getting because you're a high income individual, you definitely would want to look at real estate. If you want a low stress, you want liquidity right away, an S&P 500 is for you. But in truth, most wealthy investors own both stocks for long term growth and real estate for stable cash flow and leverage. And if you ask Violeta and I, we own both as well. But we know that because we're putting more effort into our business, for example, Violeta is right now semi retired. And I am on the way to retirement because we're putting more effort into our business from loading that effort. Then we can see that retirement line closer to our lives.
You should do both if that's something that you want to do, because it's two different options. As we mentioned, the cash flow is something that you could do now, and we're working towards like retiring early or being work optional. The stocks is more of a long term thing. That's like I always see that as like something in the future. That's my safety net, and real estate is my now, so I could start getting the life that I want now. So it's a good idea. Like Lynn said, a lot of wealthy investors have both because they want to retire or just build wealth easier and faster. And you're diversified. You have stocks and real estate. But yeah, really, it's not about, again, figuring out which one is better. It's just figuring out how you can incorporate both of them to help you meet your goals, your timeline. And again, like Lynn was saying, basically what fits your personality. Because, yeah, of course, we advocate and promote real estate investing. But yeah, real estate investing does come with some risk. And maybe you're just not there yet, or you don't have the temperament, and maybe the stocks is more your style, especially if you're a person that enjoys working, enjoys your career, and wants to continue doing that, and aren't too interested in like not working or retiring early as some are. It depends on you. It's what your financial goals are. That's the important thing. Talking about the two options that you have available for you. So yeah, hopefully you found this video helpful. Make sure you hit that subscribe button, that like, and let us know your thoughts on whether you're investing in real estate or just stocks, or are you interested in doing both. And make sure you follow us for our weekly breakdowns and follow us on social media. And we will see you in the next video. Bye.
Bye, guys.